Well, I think we can clearly say that this is going to be the best session of the event.
I'm pretty sure you said that about your panel last night, Pat.
I love all my panels equally, and I think this one is going to be super special because we've got 4 contestants and they are fairly opinionated, and so we're going to give them a soapbox to rant away.
That's right. We've asked each of these 4 panelists to think long and hard about the thing that they hate most about our industry. The terminology, the trends, the fads that we get swept up in talking about, but actually deliver very little value. And this is their chance to rip those fads apart live on stage.
And so we're going to have a competitive element to this. So I hope everyone is ready for a bit of a rumble. So each of the panel will debate each topic before we crown a winner. So let's get onto this, and let's start with the first contestant. So first up is Melissa, who is a global early stage investor. Have you got some fighting talk for us, Melissa?
You know, I knew you were going to pick me first because I didn't go first earlier, earlier in the day, and I went rogue on you. So thank you, Pat. So the payback's a bitch. So let's talk about what I really despise. Okay, so there's one trend I absolutely despise, which is the hype around neobanks. So the world, every single venture capitalist has decided once somebody hits 1 million customers, they add a 3 to 4x multiple on the valuation, even though the neobanks that are out there today have very little in account balances. So when you take a credit union, their account balance is about $200. When you take a bank like JP Morgan, it's like $1,350. So why do venture capitalists decide that they should put this enormous multiple on a consumer who's got an average bank balance of $20? Now, I understand they're extrapolating that someday it's going to be worth a whole lot more money, but our industry really has to learn to separate who really has something that's differentiated. And if you take WeBank, they have 200 million customers today, 100 million active users, about 7,000 renminbi. And when you think about it, today they've got 35 billion assets under management. When you take every other digital bank in the world, they add up to about, somewhere around 30 million customers, nowhere near where WeBank has been. So what's my beef about all of this is that, yes, digital banks are pushing the banks, the incumbents, to do things that are better for the consumer, lower overdraft fees. But really what gets me is the valuations that are associated with neobanks today, because it's just hype, and it'll be a fad, especially if we have a lot more digital regulation, and they're going to have to start to behave like a regulated industry that handles people's money. So the real beef is not that you don't need a digital bank, but it's just the valuations are insane.
Joel, you look outraged by what Melissa
I am stunned. I'm stunned, and I'm still trying to figure out how to say this comment without aging myself too much. But I think it's
super older than I am, Joel.
Well said. That's even worse. It's even worse. But if you think about, Google was probably the 25th major search engine, right? And we could easily have said, why do we need a Google? We've got a Magellan, we've got a Yahoo. Netscape is still scraping along. And effectively what you're investing in is the capacity for change, right? The ability for an organization to be customer-centric, give them what they want, and scale faster than a whole bunch of people that frankly think they're doing pretty well already and don't see their need to change, right? So I think there was a quote from the head of Bank of America who said he was the largest millennial bank in America. Like, well, sure, that's true. How long will that stay the case if you, in fact, don't have the capacity to change very, very quickly, right? So the valuation you're buying is the ability to affect change in a market where almost all the players are static and can't make decisions quickly, right? So I think that's what I think look at as the valuation premium, not whether or not their marginal non-functional checking account is better than a highly robust checking account that's been around for 40 years.
So Joel, I think the price to dream has gone out the window, when the bubble bursts.
Maybe, but remember, all these big internet companies, the bubble burst 18 years ago, the bubble burst 15 years ago as well, and all of them grew on the back of recessions, right? They didn't grow on the back of good times; they grew on the back of bad times, right?
That's fair.
And what you've got here is you've got Melissa from a VC perspective arguing on the way in when neobanks are raising money, the valuations are too high. So if we jump forward and we see your portfolio with a few neobanks looking to spin off an IPO, pretty sure you won't be arguing that valuations are too high then. I think you'd be justifying the valuations.
No, I think I'd argue they're too high.
But what you're saying is you're saying that some valuations are too high, not all valuations are too high. So how that pretty much stands firm for just about every industry or every subsector, to be able to argue that some valuations are high and some valuations are not high. I think you find that it reverts towards the mean in the end.
So Sachin, I know you wanted to pick neobanks. So what's your counter argument?
Well, it's a simple one, Melissa, right? Who enjoys going into the bank? And I know this is the overarching thesis of a neobank, but I have a great relationship manager in India. Everything gets done by who you know. And I still despise going into the bank, or when they call, I'm like, oh shit, there goes 10 minutes of my life, right? I think that's the big problem. I don't know about the valuation world, but is there a real user problem to be solved? Absolutely. I mean, everything that you need to do with a bank, a traditional bank, is fraught with pain and suffering, right? So if somebody can solve that, to me, that's the excitement of a true neobank that could be built.
Looks like you've had a few years of suffering, Sachin.
The white hair.
Yeah, it's a salt and pepper look. Joel, Melissa, do you want to defend anything here, or do you think you've kind of you're winning the argument?
No, I mean, I think the valuations are absurd, and I'm sorry to say, and I do agree with Stuart, they revert to the mean, and I think that's been proven in alternative lending. Look at Lending Club and On Deck. At some point, they become valued as a financial institution. You can't be valued on price to dream forever. Now, when it comes to a neobank, yes, everybody, most people do not like their bank. Personally, I tend to like my bank, but I've opened a bank account at every single one of the neobanks. And I would say, the fact that you can't have 24/7 customer service, or you're only insured up to a certain amount that's less than one of perhaps, one of the larger incumbent banks, is problematic if you're going to include everyone in to get to the average bank balances where the valuations make sense. And so that's my counter argument. It's not that I'm against digital banking. I think digital banking is great. I'm against the hype around neobanks.
Is there one neobank that you actually like?
I have a very large admiration for WeBank. I've interviewed Henry Ma 3 times, and I think what WeBank has created is the gold standard or the platinum standard, and they've done a remarkable job.
So what you're saying is that some valuations do hold up and some valuations are justified. And you're saying most valuations don't, which is a little bit of sort of an economist's way of having a bet each way, isn't it?
Oh, I think that WeBank has proven themselves not only from a financial perspective, but also from a technology perspective. They've done an amazing job, not only with the onboarding, but if you look at the digital architecture that they have built, it's absolutely the global standard. And I think point being is that, if you look at the valuations around the rest of the world and some of the infrastructure, it's nowhere near where they are. And yet the valuations are just way ahead of themselves. Now, maybe they'll grow into it as more and more people shift, but a lot of things have to change at the neobanks, including much better architectures. They have to be 24/7 as far as banking services. They have to prove themselves in a regulatory environment, and they have to, be resistant to cybercrime and hacks. At that point in time, then you'll have a mass market where maybe they deserve the valuations they're getting today. But clearly, we're in a price to dream mode.
But
It feels like we're landing. Go on, Stuart. Final comment.
Isn't the bet that the neobanks will be able to deliver the digital delivery of banking services and are a superior position versus traditional banks that are dealing with some guy called Wade who still knows how to program COBOL because that was what he was doing back in the 1960s? This is why the valuations are high, because this is about a structural shift in the banking service offering that's happening as we watch.
Well, banking software is being commoditized. If you look at Sunline out of China, where you essentially can implement probably one of the best banking as a service architectures and do it for free and marry your existing legacy system, that's where you're going to get, the real shift. And then, you're going to enable even incumbent banks to do that. But, those things have to happen. But, the neobanks have been pretty fortunate not to have a hack so far. And they've had a pretty light regulatory environment. that clearly will change in the US. I can't speak for the rest of the world, but that will change.
All right, we're going to wrap this one up. So it sounds like valuations might be too high. There's some work to be done on the technical architecture, but Satyan, there's a real need to prevent you getting more of those grey hairs. So next up, we have Joel. So Joel has previously served students at PayPal and Grab, and he's now head of APAC for Rapid. And one of my favorite Joel stories is how he received a multi-million-dollar investment over a burger and potato head in Singapore. So the other panelists should watch out. Have you brought any burgers for us today, Joel?
I have not. I did walk past Shake Shack for you, though, and think about it.
What was the burger? I'm curious. It must have been a damn fine burger.
Always a fine burger. No, I like the potato head burgers, in particularly in the pre-Shake Shack era, but I like them a lot. I like the spicy ones, by the way. So I'm going to actually build on what Melissa said and maybe reframe it a little bit. So when I look at the same problem, the thing that chaps my hide, as my people say, is agile, right? Because if you're talking about a legacy bank, they want to wave around agile in lieu of actual organizational structural change, right? They want to say we're iterative, we've empowered our employees, we're responsive to what customers want, we've accelerated our decision making, and if they're really excited, we can unpack our assets in different ways and really remix the banking experience to deliver what the customer really wants. The reality is none of those things are inherent in Agile. Agile is inherent in those things, right? If your organization is not capable of becoming a customer-centric, iterative, empowering, decision-making organization, Agile will fail for you just like everything else you've tried all the way going back to the COBOL era, right? You have to embrace that change and lean into it in a way that tool helps your employees do better. Agile is not in and of itself something. To bring together, Melissa's points to some degree, when I look at the best and most exciting and most terrifying neobank in the world, it's Goldman Sachs, right? Because they literally have no dog in the hunt when almost everybody else's revenue, and they can afford to give away everyone else's revenue on a platform that is massive, scalable, well-licensed, right? And monetize the holy hell out of it. All they need is distribution partners, right? And they picked a pretty good one for their first, and I doubt very much it's going to be their last, right? Major distribution partner. So that, I think, is really the change that we need to see in our industry, is this commitment to customer centricity, making decisions more quickly, being much more responsive, versus repackaging the same old bad or slow decision making and hoping that makes a difference, right? If you think about the neobank revolution, I certainly agree that it's a little bit oversold. But most of it comes down to whether or not EKYC is legal in your country or not. If EKYC were just legal, everybody would do it. And guess what? Everybody would really be a neobank, crappy or not crappy. But they would still have to make this customer-centric investment in a product people actually want, right? And the people that build the best customer-centric product will scale the fastest, right? And who can bring the operations behind it. People who don't will die, right? Like everything else that's happened in our network-based industries, right? We aggregate scale at the people that can do it the best, and very, very quickly the people that can't scale fall apart, and the market share goes to the winners. So that's my 2 minutes.
Melissa,
That's a very good pitch.
Agile versus customer centricity.
So Joel, what's the fad you don't like? I'm a little confused.
Agile.
Well, the incumbents are not agile, because if they were, I wouldn't have a position. I wouldn't be in a VC firm.
There you go. Yeah,
not agile.
I think that's the issue, right? But if you look at larger banks, right? Everybody that they read, they're not incapable. They'll adopt the language, they'll adopt the clothing, they'll streamline their dress code, they'll have open office plans that look like Starbucks again and again. But unless they can actually make the organizational change, all those things are just window dressing.
I think the insurance companies and incumbent banks have a very challenging time being agile. I mean, people, I have to agree. Most people tend to think about getting fired than, making change that's for the benefit of the consumer or the enterprise. And just if you look at the enterprise sales cycle, it's 3 years, and it's very hard to shorten it, and even more difficult under COVID. So they're not, I have to agree. I mean, they're completely not agile, and I'm very thankful they're not, because
Melissa, that's not the point of this game. Really, we should be asking why banks should have ping pong tables and coffee machines and look and think like a startup, but not really think like a startup. Stuart?
You did this yesterday, Melissa.
I'm sorry.
I think what Joel has successfully argued is he successfully argued why incumbent banks are headed down a path that means that fintechs are going to win.
No,
And
he
if we look
talked about Goldman Sachs was great. I agree, they're amazing.
But if we look though at the opportunity and what we see, what individual fintech businesses are doing, it's because they embrace the philosophy and the principles that are embedded in Agile that enables them to succeed. If you look at the organizations that are incumbents that are pivoting and are able to adopt some of the methodologies and approaches that your faster fintechs are taking, they're agile principles. 100% agree that just because you got a t-shirt and you print it out and it says we're agile, that doesn't make you agile. Here's to you, ANZ Bank.
Stuart, are you wearing a Money Place t-shirt right now?
I am wearing a Money Place t-shirt, but it's not an agile t-shirt, it's a Money Place t-shirt. And that's because everything that Money Place embodies is already agile. So the argument that if you're positing that banks are never going to be able to succeed because they're on this kind of whole fake agile thing just because they got a t-shirt and a coffee mug and we all get to hang out and follow an agile philosophy and put post-it notes on whiteboards and stuff like that, yeah, sure. But fintechs are succeeding because they already embrace that.
I was going to say, surely everyone likes a scrum in the morning, but Sachin, what have you got to add?
I despise scrums in the morning. The worst way to start a morning. It's like, what are you blocked on? What are you blocked on? Tell me. Oh, there goes my day. But my point would be
mornings anyway, though, Sachin. Like, let's be clear. Like, mornings are just not your friend.
But I'll give one example to counter Joel, right? And India's largest private bank, $100 billion worth, the HDFC Bank. Laggard when it came to the India fintech wars in the first part of this decade. And then they've ramped up. And I would say it's the personality of the leadership team, but just said, this is what we're going for. So we all like to think as fintech that banks can't move, but the right banks and the right bankers, I would say, more than the banks, actually can do tremendous stuff. The topic I was going to talk about later is consumer lending, but the same bank, when it came to lending and they saw all these fintech startups doing lending, the CEOs on record to say, I don't get it. What do they have? All my RMs have to do is look at your account balance and your cash flow history to say instantly, can I give you a loan? They built some in-house software and they crushed it, right? And that's how they can react, not in the fancy coffee shop, open environment, but they have incredible data, they have customer outreach, they have trust. I think we take it too lightly as the innovators to say some banks will not change really fast to crush us.
No, I'm sorry, Pat, I'm going to say build on, but to attack Satyan's point that I agree with, you look at a different major industry similar to banking, go with telcos, right? And telcos have been making neo-banking investments longer than almost anybody. And with almost zero exceptions, they've totally failed, right? Many, 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 many billions of dollars have been wasted building, fintech apps since the early 2000s on top of telco platforms that basically were slow to respond, not what the customer is looking for, marketed like you're selling a submarine to the government, right? And only a very few examples that anyone can point to around the world, one of which launched, I think, in 2005 in Africa, right, have been successful, right? Because those organizations weren't customer-centric organizations. They were marketing organizations selling infrastructure, right? And so they had the t-shirts way before t-shirts were cool, but the products didn't sell through because they really didn't have the customer in mind at a deeper level.
But Joel, I have to counter that just because it's almost like I paid you to give that response. The biggest telco in India that's emerging is Jio. In the last 3 years, they have 350 million consumers. They started about 3.5 years ago. They just announced in the last 3 months of the pandemic, $25 billion in global investments coming in from the likes of Google, Facebook, Microsoft, and others. So again, goes to my point, every telco might not be great. You need one or two of the incumbents who say, I'm going to crush it and I'm going to win this market, and you tiny fintechs are nothing, right? You're noise.
Sure. No, I think you're terribly wrong, but at the same time, 100% right. But remember, what's the thing that's different, right? You have a person that thought differently, and the product he was selling wasn't a telco. It was basically SoftBank, right? How do I aggregate other people's money, repackage it on a distribution platform where I'm willing to lose money in the short term to make money in the long term, right? And we're now, I think this week and last week, seeing the fruition of this capital reallocation strategy on a platform which, you know, I don't think has been making money in its formation phase, right?
Melissa, is there anything you want to add before we wrap up on this particular fad?
Well, I think Satyan's right. I think if you take Goldman Sachs as an example, I mean, with the Marcus platform and the deal they cut with Amazon, it's amazing. They have excellent engineering. I think they've done a great job. They weren't the first to the market, but they're clearly a player and will be for the future.
Okay. Well, in that case, I think we're going to move on now and kind of introduce Satyan, a serial founder and self-confessed Mumbai playboy. I'm sure you're going to love me for saying that. He's also the Indian equivalent of Wolverine. See, they're coming out thick and fast now, Satyan. And the founder and CEO of Cube. So thanks for joining us, Satyan. And do you want to share with the group your fintech fad that you're going to defend vehemently?
Absolutely. Well, I'm going to go against the fad, right? Which is consumer lending in India and Southeast Asia is what I've picked. And I know this is a hot favorite everywhere. It's hot, it's sexy, it makes money in fintech, which is a rarity. But at first, my point is it shouldn't be. And let me throw some data points at everybody to explain why my argument is so cautious about this. If you just look at purchasing parity, right? The US is at number 10 in the world with $67,000 household income.
And dropping.
And that's the reason I'm going to come to as well. India, for example, is at 116 in the world with 9,000. Southeast Asia, Bangladesh is at $5,500 a household. Vietnam at 8,500. US household debt compared to 67,000 is 137,000 a household. You get a 2x ratio. Exactly, 2x ratio already in what's considered a very mature lending market. Your personal aggregate amount of loan in households is $13 trillion in the US. And as a country, the US owes $26 trillion. Why do I highlight this? This is the economy we are trying to ape in Southeast Asia when we get all excited about consumer lending. I mean, what's wrong with us, right? So let's talk India, Southeast Asia. It's fragile family financial status at the middle of the pyramid, let alone the base. Essentials are at daily risk. People barely make it last through the month while living in a slum. And you're now talking about giving these guys loans so that they can buy the latest phone or go on a vacation or buy a flat screen TV. That's insane to me. I mean, I'm not talking about exceptions for lending, such as buying your house, buying your first vehicle, etc. I'm talking about go splurge is what fintech is encouraging in Southeast Asia and India. And now we are getting, in the last 4 months, the first glimpse of our future days of reckoning. The lockdown has had the regulator impose a moratorium on lenders on saying you can't collect interest payments. And you can see the tide goes out and you can clearly see everybody swimming naked because suddenly your NPAs are going through the roof. And yeah, it's a moratorium even for the customer. But if they could barely pay you per month, how are they going to pay you for 6 months worth of interest when the moratorium is lifted? So my conclusion is, we get all excited about consumer lending. We forget that there's a local culture that we must respect, a local economic situation. The local culture in Southeast Asia has always been about being conservative in the household as opposed to excessive consumption, and we are losing that. We should, in fact, encourage more investing, more money into driving savings, creation of emergency funds, as opposed to encouraging everybody to party like it's Vegas. And that's why that's my favorite anti-fad or fad in Asia.
Hot and sexy, consumer lending. What a great quote. Joel, over to you.
There's so many things to disagree on, but I guess you're probably used to that. When you think about why do economies grow, right? Going back literally thousands of years, right? Credit is an essential component of that, right? You can't save yourself to growth, right? You have to literally create new capital through a multiplier effect. Otherwise, you go from a low linear growth rate, and you don't unlock this non-linear rapid growth. You're right, of course, that 80 or 90% of the population is buying flat screen TVs, or even worse, non-flat screen TVs, and chucking them out the window. One of the younger people on my team asked me the other day about collateralized loan obligations and whether or not the world would be ended. I was like, oh yeah, we've done that before. Yes, it will be ended because of this, lending bubble and securitization, et cetera, where all these horrible things we remember from 2008 are all just about to happen again. Good times. But at the same time, when you think about how does an entrepreneur fund their first round, right? How does someone start a normal small business? They started on personal credit, right? If they don't have personal credit or they're very rich, they don't start a business, right? So in the US, startups go on credit cards, they go on my friends and family's credit card, et cetera. If consumer credit isn't available, those businesses don't get off the ground, right? So I think you absolutely still need to have that top-end consumer credit available to make change happen. Right? Because big banks that we talked about absolutely are not going to lend to you. They don't lend to small businesses basically in the first 3 years of operation, even today. So you still need that consumer credit where the entrepreneur's butt is on the line to make it happen, to get the idea to the point that Melissa will even talk to them.
Absolutely, Joel. So I'll make two counterpoints quickly, right? There is a need for essential credit, right? As I said, in consumer space, maybe buying your first house, your vehicle to get to work, and same way for entrepreneurs, et cetera. So not arguing against that. I'm talking about the discretionary credit that's fueled by Instagram and the lust to live the life everybody else is living. And the second part, which is very different from the developed world, whether it's Western Europe or US, is in Asia, most places don't have a social security net. You take a personal line of credit, you can't pay it off, you are literally out on the street, you have mortgaged your house, et cetera, which is a huge difference. So when we compare, it's really not apples to apples. And we say everybody should take money because that's what's proven. Here, if you take money and you can't pay it back, your life takes a very different trajectory. You don't bounce back like Silicon Valley.
I want to come and take a loan from you. Like, you're literally there throwing money out to everybody. What you're arguing is that consumer credit is bad and is a fad. No, you're arguing that providing shit loans to consumers who can't afford them is bad. That's what you're arguing. Consumer credit is a massive opportunity. Why? Because consumer credit hasn't really changed in the last 100 years. It used to be one person goes up one side of the hill, another guy goes up the other side of the hill, exchange cash, go down, make payment. That's pretty much how banks still operate today. But it's the fintech consumer lenders that are actually revolutionizing credit. They're using alternate data sources to be able to better price loans, to be able to use risk-based pricing to make credit more accessible to everyday consumers, whether that's an ordinary person in the United States or if it's somebody in Southeast Asia that otherwise hasn't had access to credit. That's why consumer credit is such an opportunity, and consumer lenders are doing so well.
And Stuart, completely agree and disagree, right? And I mean it, and not just for the sake of the panel. Absolutely, it's needed. But like anything else, it's needed in moderation, right? I love my old fashioned. If I drink it every night and I drink 10 of them, I'm in trouble. And I think that's my point, that we are trying to emulate what's a house of cards in the Western world and saying that's the right model here. It's not. We know all the ratios of the banks, all the lending that's going on Wall Street. Why is Southeast Asia not learning from them and saying we need to be more cautious? Just because VC money is available to fund every guy who says I'm an ex-banker and I know how to give out loans.
But the goal of the lending industry, right, isn't to make money on an incremental loan, it's to make money on the portfolio, right? You make big bets and you make money at the portfolio level. And so far, banks' buildings get taller and taller. So it's actually working out okay. The question is, can you do it smarter? Can you do it more efficiently with less loss, et cetera? I think if you go back to the entrepreneur angle, I don't know how you differentiate from a 25-year-old entrepreneur who's interested in fashion but can't afford it, and 2 years later takes that same credit card or same line of credit and starts a business, right? I don't think you can figure out who that is unless you deeply get into the psychology of the person. But someone somewhere has got to give them way too much credit so they can use that to start a business, right? If everybody's got a $1,500 credit card, no businesses are going to get started on that. Some dummy's got to give them 20 grand so they can get to the races.
But consumer lending hasn't been successful in the U.S. for about 5 years now. So when I in Southeast Asia, when you get another business plan for another SME lending platform or consumer lending platform, you're like, really? Like, that hasn't happened in years. Why? Because the on-deck's market cap is $50 million. Down well over from $1 billion. Or you take Lending Club, it's a disaster. Or you take SoFi, haven't gotten public, or Avant, or just go through the list of, there were hundreds and maybe thousands of consumer lending platforms. And you know what? Yeah, some will survive because consumer lending, as Stuart said, has been around for hundreds of years, as has buy now, pay later, and other couple of business models. But they haven't proven out to be good venture models. People haven't made money. But what did happen, and I agree with you, is that, encouraging Southeast Asia to act like America, where every household is so in debt that they can't afford deductibles on their healthcare insurance package, or they can't barely make, to the next paycheck to eat. And yet, they're driving a BMW and have 5 flat screen TVs. No one said the Western model is one to emulate. And probably, 5 years from now, people will definitely take a different position. I think when you need money for things like healthcare expenses and education expenses, and yes, maybe, Joel, they're not buying the next, dress, and they're saving for starting a company. Kind of doubt it, but people have used, people do use their credit cards to start companies, but that's a pretty limited and small group. But I think the consumer lending fad and SME lending fad is going to have some real challenges, especially since the capital for the credit lines is just not going to be available. And if it is available, it's going to be based in USD, and then you're going to get huge exposure on the currency side. And so it's going to be a very, very challenged industry. And it clearly is also overhyped in Southeast Asia today.
Melissa, you're disagreeing with Satyen.
Go ahead.
Go on, Satyen. Wrap it up in just a
wrapping up. I'm saying I've clearly proven my point, because the power that Joel is saying lending businesses construct over the portfolio are crumbling, according to Melissa herself, right? There's no real money to be made. And my core point stands saying, ethically, is it the right thing to do? Absolutely not, in an economy that doesn't have a social safety net. And I'll close by saying I'm an angel investor, and the only lending investment I've made is in a collections company. What does that say?
Well, we're an investor in True Accord. Go Collections.
Thank you.
There's some kind of alliance forming here. I'm not sure how you guys feel about it. On to the final fintech fad, and last but certainly not least, Stuart Stoyan, who is a professional mudslinger who in his spare time runs the Australian fintech money place. So Stuart, take it away. What's your fighting talk?
Yeah, I think just in rebuttal to the last session, as a CEO of a consumer lender that is both profitable and cash flow positive and doing quite well in Australia, I kind of completely disagree with everything you were saying. But what I'm talking about is I'm talking about the founder fallacy. And so what this is that it's become fashionably woke to call out that life as a founder is really tough. So there's a mistaken belief that founders take on a massive amount of risk, to be underpaid, to be overstressed, to work ourselves 24/7. With most startups failing, it's pretty much all for little gain. It can be relentless, it's unforgiving, it's isolating. And we're talking about things like the emotional cost of being a founder. Woe is me, poor founder. She whose closest friend is the guy who runs the 7-Eleven graveyard shift. He whose wardrobe now consists of nothing but company swag. Boo-hoo. But the idea that life as a founder is hard, simply not true. Being a founder is awesome. If your business succeeds, you'll be heralded as a god, and you'll have more wealth than can be spent in a lifetime. A more likely scenario, however, is that your business fails. So what does this mean? This means that you'll be immensely employable. You'll make a great co-founder, or maybe you've got a second startup idea that works this time. But if you want to avoid startup land completely, fine. Go take that job at HSBC. Earn $500,000 as head of innovation, whatever head of innovation does. That doesn't float your boat, then become a partner at EY and earn millions of dollars consulting to the very head of innovation at HSBC. What I'm saying is that a founder takes on a calculated risk that'll either result in Lamborghinis or it'll catapult you into new opportunities. In either scenario, you form bonds with amazing individuals. You'll push yourself to levels that were previously unimaginable. And what you'll find is that you'll just gain immense knowledge and experience that is unparalleled anywhere else. So they say that being a founder is really tough. No, it's not. Having an idea and never pursuing it, having an ambition that's never realized, that's tough. And so that's why I'm calling BS on the woke belief that, you know, life as a founder is tough.
That's just bullshit. Life as a founder is extremely tough. It is extremely tough. It is an extremely lonely place. Being a founder, which I have done, whether it was Arbor Ventures or before that in my startup, is very, very difficult. Every day, every time you walk in the office, people look at you or you're on Zoom and they want to see how are things going. You know, are our investors happy? Did we make progress? And things are sometimes completely out of your control and you have to figure out how to solve those problems. But being a founder is absolutely very tough. And if you're really, you know, most of our founders take a very low salary, much lower than what they would get. And yes, the upside can be stupendous and incredibly rewarding. And yes, perhaps Lamborghinis, but that is such a small percentage of people who actually achieve that. And most founders spend a really long time struggling every single day to build an organization, raise money, fight through the challenges. And it's extremely lonely and very, very difficult. And so I'm very empathetic for our founders to be there for them because it is hard. It is
100%.
very hard.
Boo-hoo. You go into that knowingly. You're getting a massive payoff if you're successful. And look, maybe it's not where you take your job at. Maybe you end up joining a VC firm as a junior analyst, helping to be able to field opportunities to be able to invest in other founders. There is an overstatement, a massive overstatement of the downside risk of being a founder. Sure, it's tough, but any job is tough. I mean, you know, being a professional panelist doing the conference circuit, that is a job that is truly difficult.
What do you have against EY?
What's really tough is you're out of money because your VCs haven't funded you yet, and you're putting your entire payroll on your personal credit card. That's really tough. And guess what? Somebody working at HSBC comes in at 9 o'clock. They go to the water cooler at 9:30. Then they go to the coffee machine at 10 o'clock. Then they go to lunch and they come back. And guess what? They don't have anywhere near that amount of stress.
Yep. And you couldn't make payroll without a credit card.
You're embracing that methodology and then able to be able to bounce and dodge those bullets. Thank God you've got an online consumer lender you're able to go and get some cash from, and you're able to then be able to put that back into your startup idea, which is pivoting into becoming the giant, biggest neobank in the universe.
Stuart, well, I've been a founder for now 21 years straight. And when I first met Melissa, actually, 2013, we spoke on the phone, we didn't meet. I'd been in my career, professional career for, 17, 18 years. And my salary in 2013, when my company was doing $100 million in payments, was lower than my first ever job. And we not hit success. It wasn't a choice. And this is while dealing with VCs, with my team, looking them in the eye when we knew we had no money in the bank to survive for 2 months, and saying, better do your job. We're doing really well. And because of you, we are going to grow together, right? You're effectively a liar to your own team that trusts you. And this is part of the game. My take is you need to be a masochist to be a founder. You can be purpose-driven, all the fancy stuff. You need a personality kink which says, I love pain and suffering. And if you don't embrace that, you're going to go through some really dark times. So I would say I love what I do, but I completely disagree. I mean, there is, on a daily basis, it's a painful existence. At a macro level, it's fabulous.
So I can't help but think this is first world problems, guys. But I was just going to say, we're going to have to wrap up. We've been given the nod. So I think that was a very, very good pitch, Stuart, and a good counter arguments as well. So Becca, do you want to start the wrap up for the session?
Yeah, I think if I'm going to crown the winner, which I am, I would say that Sati and I was very impressed with your rebuttals for this session. So well done you. But overall, Stuart, with your poetry for your pitch, Stuart, you're the winner for this session. I crown you the king of fintech fads. Round of applause for Stuart and for all of our panel. Thank you so much for joining us.
Thank you, guys.
Thank you.
Thank you.
Thanks.